It's April 2019 and another edition of the Zacks Ultimate Strategy Session, one of your benefits as a Zacks Ultimate member. This month, Sheraz Mian and John Blank agree to disagree on whether the end of the U.S.-China trade war will spark a new leg in this bull market. Sheraz and Kevin Cook have the portfolio makeover. Kevin Matras answers questions from the mailbag, and as always, there's top stock picks and more. But first, John Blank and Kevin Cook share their fundamental and technical market views.
Hi, John Blank, Chief Equity Strategist of Zacks. Going to do my global macro outlook for a fundamental analysis. What this means is I'm using my quarterly data that I collect from a variety of metals and agricultural products and gold and silver to teach you about the global economy. First point I want to make is global economy is probably going to be fine in 2020. Markets are trading on 2020 right now, not 2019. That's why things are more positive than you think. So let's go to my next points. Zacks Global Macro 2, fixed income. I don't want to talk about it a lot, 0% hikes, and that's not a problem. The bottom point of this slide I want to get to is Swiss franc, euro, UK pound, and krona. Those are European currencies. Those European currencies, by the way, are showing you where the weakness is in the global economy. Europe is weak. That's the inversion you got to worry about here. You need to worry about Europe, but that doesn't mean you may worry about European stocks. Just worry about the economy. Next one, precious metals. People talking a lot about gold. Buy gold because of inflation. Well, there is no inflation. There is no play in gold. You want to understand platinum and palladium. This is a more important subject. And the basic point you want to understand is palladium has more play for electric vehicles and pollution than platinum, so it's getting more of a bid. It got a big sell-off, but you basically want to understand there's a real change going out there in the metals markets about what can conduct electricity better and what can help work out with batteries better. So, base metals, aluminum, and Dr. Copper. Dr. Copper firming up. Actually, that's positive for the global economy. That's all you want to know. It's not firm, but it's firming up, and that's the point I want to make here. Copper is not telling you the world's falling apart. Oil, $62 a barrel. That's basically where we're trading now. So the market's telling you that actually oil has firmed up, and this is all OPEC, by the way. It's not global growth. It's the OPEC story. This is good news for the frackers, actually, in the United States, but it's actually driven by the OPEC tightening. So pay attention to the fact that OPEC is driving this, nothing else. Ags, all I see here, other than live cattle, is positive news for the ags. Now, you're out there in farm agricultural land in the United States, you think that's garbage. Remember, this is global. This is just telling you about the demand-supply situation as it's driven globally by demand is actually firming up. Things are better than you think. So my point with my global macro today is inflation. We don't actually see it yet. Firming up in the economy from copper, we actually do see it. Europe is the weakest place, and no matter we're looking at the krona or the franc where the safe havens are, or you're looking at the UK pound and the euro where the issues are with Brexit, there's a lot of things to worry about in Europe. Keep your mind around that. That's where I would keep my worry at. But by the way, all these other groups, including the energy markets, telling you actually the global economy is firming up. That's why the markets are trading higher than you thought it was going to trade this type of year, because actually we're trading a market on 2020 terms. Keep that in mind. That's what I have for you in Outlook today. John Blank, Chief Equity Strategist.
Okay, we've only got a couple of minutes for this, so I'm going to show you things that I think are the most important that you should be looking at for the current market right now. First, we're going to go to the NASDAQ 100, QQQs, NDX, but we're going to look at the equal weight version. So take a look at my screen here. This is the equal weight QQQ ETF from First Trust. There's a couple different ones out there, but this one works just fine. And what you'll notice is the market making new highs in the equal weight NASDAQ, okay? If you could see the September, October highs out here, they would be, considerably lower, whereas the NASDAQ 100 has not made new highs. The NASDAQ 100 itself. Now, this is important because the NASDAQ 100 as a cap-weighted index is 30% Apple, Microsoft, and Amazon. Three stocks are 30% of it. So what is this telling you? It's telling you that the big cap FANGs have not, even though they've done well, they haven't led the rally. There's a lot of other stocks, 97 of them at least, that are leading this rally. So that's indicative of breadth. And obviously we've seen it because the semiconductors have made new highs and software has made new highs. Let's just take a look at software real quick. Here is the, this is a cap-weighted software ETF. I should really show you the equal weight one, but there you go. New highs versus the fall. So IGV is cap-weighted, think CRM. And if we want to look at an equal weight software ETF, we go with the S&P XSW. Get that up here, okay. And, you know, another beautiful chart making new highs. This is your smaller software players, and we've just seen tons of them. I've been talking about them like crazy in Taser. It's, you know, you just try and pick a winning pony there, and there's plenty to be found, but they have run quite a bit. All right, next thing you want to look at is advanced decline new highs. Now this is the NIAD. Take a look at my screen here. The NIAD, advanced decline issues. This is what a lot of old-time institutional investors look at. They want to see, you know, is there net accumulation? Yeah, and so these are the advanced decline statistics. This is cumulative, so that's why it looks this way. It's not a daily thing. It's added up. The idea here, it's made new highs. But I'm not crazy about the NIAD because the New York Stock Exchange has so much other garbage in it with ETFs and bond funds and closed-end funds. So I prefer to look at some version of advanced decline on the S&P. So we'll do the S&P advanced decline percent. And same thing, I'm looking at it on a cumulative basis, 3 years here, and it's roared to new highs. This is speaking to, you know, the old model of technical analysis that the index should soon be able to make new highs with this kind of advanced decline momentum. All right, last thing I want to show you is volatility. What if volatility comes back? This is a great study that JP Morgan did. It's just a simple quant graphic where they're looking at liquidity being strongly negatively correlated with volatility. So on the x-axis is the VIX, basically, volatility. And on the y-axis, they have some measurement of market liquidity. Notice how high market liquidity is when the VIX is low, when the VIX is in 10 to 15. When the VIX ramps and volatility is increasing, liquidity goes out the window. And this is measured in S&P futures, I believe. Yeah, S&P 500 futures versus the VIX. But it's a quantitative model. It's a way of looking at what happens to liquidity when volatility rises. For me, the two takeaways are, one, it reminds you that in a steadily rising market with low volatility, you know, and 2 to 3% pullbacks at most, the machines dominate both two-way flow, and they make a ton of money because they can take on huge risk in small trading ranges and just keep flipping it back and forth. But when volatility increases, they're better off pulling the algos and backing away. So just something to keep in mind when volatility does come back. All right, thanks for joining me.
We'll see if Sheraz Mian and John Blank can agree to disagree right after this list of recent Zacks Ultimate top movers.
Hi, John Blank and Sheraz Mian. We are going to be talking about a bull bear, but it's probably better to use point counterpoint because there are so many nuances in this discussion. But the idea here is we're sitting here with the S&P back at its highs, and we're looking at a trade deal between the U.S. and China sometime in the next 2 months. We all know that. Question is there going to be another leg another leg of this bull market from here. So with that in mind, I'll let Sheraz open with a point, and I'll take a counterpoint.
I strongly feel, John, that the rally we have had since Christmas, it's not entirely just this Fed optimism, this Fed sitting on the sidelines, and that putting us back to close to the early October highs or whatever that point was. I think there's a fair amount of this trade deal already priced in. Of course, a fair amount is not an accurate portrayal of how much is priced in. But I could totally see, and it wouldn't surprise me if the market loses ground on the actual announcement of the deal. Now, there is so much in the details that could be important for the market moving one way or the other. But I'm coming around to this conclusion that that the optimism that we have had about the trade issue has priced in a big chunk of it, if not the entire thing, ahead of time already. So the actual announcement doesn't really put us on track for a huge new rally. It's very possible that we may start losing ground from there onwards.
Right. I agree that sell the news, right? Buy the rumor, sell the news, right? I actually agree with that. So that's why it's not point counterpoint. I don't want people to think I disagree with what Sheraz says, but I want to make my key point here, which is if I look over last year and I look at the tariffing started by this president through executive orders, not the acts of Congress, what I notice is January, when the market topped out and tanked, was the aluminum and steel tariffs and the solar panel and the washing machine tariffs. That didn't tank the entire market. It recovered. Then in June and July, what happened? It was the China trade tariffs broadly used across the entire spectrum of imports and exports to China because they retaliated. So all that noise, all the pre-tariffing and then the tariffing, when I look at things now from that perspective, I do not care and do not think the market will care about the details of this trade deal. So, for example, I don't think the market will care that there's going to be a semiconductors, $2 trillion in purchasing and take the semis up. I don't think that's going to happen. What I do think is going to happen, Sheraz, is the tariffs on the Chinese broadly, on both sides, if that is lifted, there will be a bull market because there's so much money, so much investment, so many people waiting to see what the tariff situation is, not the trade situation. So my key point, people, is tariff details matter more than some type of a line in the agreement itself.
I think that's a fair point. So if there are no tariffs when we have the agreement, that's a bull sign.
Right.
So you're fine-tuning my initial argument that the market has priced in an agreement, but beyond that point, there's a lot of uncertainty. So at the end of the day, if there is tariffs, if what we have presently that still remains in place or partly remains in place, then that gives us that sell the news type of scenario. And if the tariffs are lifted, that's a net positive. I think that's a fair point. The other issues in the agreement, if we go into the details a little bit, there's been a lot of talk about intellectual property, about the joint venture requirements and all of those things. It'll be hard for the market to evaluate those components of the agreement on day one because so much of that will be coming over time and will depend on how stringent and how detailed the enforcement mechanisms would be. So I think I'm coming around to your view that the key quantifiable element for the market on day one would be this tariff issue.
Yeah, that's it. Because what we want people to understand here, Sheraz and I are in agreement, that's why it's point counterpoint. We're not actually disagreeing here, people, is that the market is looking 6 months ahead at this deal. It is actually maybe looking 12 months ahead, but 6 to 12 and probably just 6. So what it's going to care about, for example, take the tariffing of the 6-month long inventory of chips. If that tariffing gets lifted and the global supply chain of chips get lifted, the chips can take off on an inventory reduction over 6 weeks, not the $2 trillion trade deal that, by the way, under any circumstance, which what we've seen with the Mexican trade deal, which is still not ratified, is this president, whether he likes it or not, has to go on to an election platform in a year and a half. And to that year and a half, he has to get the Congress to ratify any deal. And then there's a new Congress and a new president, which either is or is not him. And even if it is him with a different Congress, it still may not be good. So the problem with anybody's optimism on the trade deal itself is there's absolutely no way to price the thing. In fact, there's no detail you can say, here it is, because I can say that may not be there in 6 months. But what will be there, which will be coherent and which has mattered since June, if you ask yourself when the global trade growth went down, and you got the answer right, and I didn't get it right last year, but I'll tell you why I've been thinking about this hard, because I didn't. It was these crazy China trade tariffs, and that's what I'm looking at.
Yep, yep.
So anyways, we're close to the end, so I'll let you wrap this up, and then I'll make the closer.
Yeah, no, I think the as I pointed out earlier, a big fair amount of the optimism is already reflected in stock market, and the actual details, particularly the tariff issue and some of the other issues, will determine what the market does beyond that point.
Right. So I'll finish up. My point that Sheraz and I agree on is it's entirely possible to have a sell the news event. You buy the rumor of the trade deal. It's already been bought. It's already, Chinese stocks have already gone up. Chip stocks have already gone up, so they can all sell off on the news. That's a profit-taking motivation. Day one can see a 5% decline, and then people are going to evaluate the details around tariffs, and that can take the market up.
Ahead of the Zacks mailbag is this list of recent Zacks Ultimate new editions.
Hi, I'm Kevin Matras, and this is the Zacks mailbag. So I'm going to answer 2 questions today. One is a broader economic question, and the other is about the Zacks rank and style scores. So first one is the economic question, and that is, with last month's yield curve inversion, does that mean we're headed for a recession? The answer is no. First off, we actually saw a brief inversion in December of last year when the 5-year Treasury yield dipped below the 3-year Treasury yield, and that was supposed to be the end of the market, with a recession sure to take place. Totally ridiculous. Instead, the economy continued to strengthen while employment got even better and the market surged. But we were then told that that inversion wasn't the important one. The real inversion to watch out for was when the 10-year Treasury yield dipped below the 3-month Treasury yield, and that one happened in late March. That one, we were told, is the one to watch and the one that is sure to bring a recession. Again, more nonsense. Quite frankly, I would be more worried about an asteroid hitting planet Earth over the next 12 months than worry about a recession. So don't waste your time thinking about it. But regarding the inversion, let me address it. And by the way, the yield curve did briefly invert late last month. It's already corrected itself, but it's no longer inverted, so FYI. Anyways, let me start off by saying that Fed Chairman Jerome Powell, who was asked about the yield curve inversion a short while ago, responded by downplaying the suggestion of a recession. He noted that in the past, inflation was allowed to get out of control and the Fed had to tighten, and that put the economy into a recession. That's not really the situation we're in, and I couldn't agree more. The economy is humming along at a strong pace. The jobs market is literally the strongest it's ever been. Inflation is low, and so are interest rates. Plus, the Fed just last month indicated that they're likely going to hold rates steady for the rest of the year, so no more increases. And speculation is now growing that they may even cut rates. So currently, the midpoint for the Fed funds rate is 2.375%. So the Fed is not going to tighten the economy into a recession anytime soon. In fact, over the last 50 years, there's never been a recession with the Fed funds rate under 4%. So we are a long, long, long way off, historically speaking, to even think about a recession. Moreover, those panicking over the yield curve inversion and predicting doom and gloom for the market are missing some very important stats. Looking at the last three inversions, which is 1989, 1998, and 2006, the S&P soared afterwards, with the average gain from the first inversion to the ultimate high of that cycle being 35%. And the average time frame for those spectacular moves was 16 months. If anything, the yield curve inversion is one of the best buy signals. And already, since the inversion on March 22nd, the S&P has rallied 3.3%. So for now, forget about the yield curve inversion and recession. Okay, the next question is, why do some stocks have a Zacks rank of a 1 or a 2, but can have a style score of F? Well, that's a good question as well, and one that's asked a lot. As you know, the Zacks rank, which focuses on earnings estimates and earnings estimate revisions, assigns a Zacks rank of 1 through 5, with 1 being the best, strong buy, and 5 being the worst, strong sell. The style scores are layered on top of the Zacks rank and are distributed in quintiles across each Zacks rank. That means whether a stock has a Zacks rank of a 1 or 5, 20% will have a style score of A, 20% will have a style score of B, 20% will have a style score of C, and so on for each respective Zacks rank. So a stock with a Zacks rank of 5, but a gross score of A, for example, means that while it has a strong sell rating by Zacks due to its unfavorable earnings estimate revisions, its growth attributes are within the top 20% or best 20% of all of the other Zacks ranked number 5 stocks. In other words, these stocks have the best growth attributes of the stocks with the worst estimate revisions, the best of the worst, so to speak. Now let's take a look at the best of the best. A stock with a Zacks rank of 1, for example, and a gross score of A means that while it has a strong buy rating by Zacks due to its favorable earnings estimate revisions, its growth attributes are within the top 20% or best 20% of all of the other Zacks ranked number 1 stocks. So, of all the stocks with the best estimate revisions, these have the best growth characteristics as well. On the other hand, a stock with a Zacks rank of 1, but a growth score of F, for example, means that while it has a strong buy rating by Zacks due to its favorable estimate revisions, its growth attributes are within the bottom 20% or worst 20% of all of the other Zacks ranked number 1 stocks. So of all the stocks with the best estimate revisions, these have the worst growth attributes out of all of the other number 1 stocks. The worst of the best, if you will, on that particular style. And we apply this scoring for each style, which is value, growth, and momentum. Same goes for the VGM score, which is a weighted average of the individual style scores. Now, the style scores are an important part to help you select the best of the respective Zacks rank stocks. But the Zacks rank is still the primary factor. And in general, even stocks with a Zacks rank of a 1 or a 2, but a style score of D or F, still have a high probability of beating the market. But your odds are even greater with a favorable Zacks rank and a favorable style score.
Sheraz Mian and Kevin Cook handle the portfolio makeover right after these interesting insights from Zacks Ultimate Editors.
Time for a quick breakdown of another portfolio. We get so many submissions. It's really hard for Sheraz and I to pick one that will let us talk about all the things we want to talk about and you know, give a nice hand clap to the person who submitted it. But this one is big, and it's got a lot going on in it. Take a look at my screen here, and I just want to show you real quick. I sorted it by Zacks rank, so you can see that MK here has a boatload of rank 1s and 2s, and balances out the few 4s that occasionally happen. I'm going to turn it over to Sheraz right now, who's going to break down a couple of the sectors.
Yeah, thanks, Kevin. I have it, as you could see on my screen, alphabetically, and starts with Abbott and goes all the way down. We have about 30-plus stocks in it, and I really have to struggle, Kevin, to find faults with MK's portfolio. It's absolutely beautiful. There's a fair amount of tech, and within tech, a lot of chips, a lot of semiconductors from a variety of ways.
Which has worked lately on this rebound.
Which has worked great.
Yeah. Stocks index making new highs.
I'm just dying to know how he did in the fall.
Right.
And late summer, early fall, because that was the real area of pain in the market.
Right.
And
did he ride him all the way down and just hang with it?
That's right.
Which is fortitude.
Absolutely. Yeah. If he did that, we should find a way to bring him in house. He obviously has a view of the market.
Yeah.
Exactly. So a lot of what he has worked. I also like, even though I don't know these small caps so much, there's BEAT, B-E-A-T. There is this EDIT. There is this FNKO. I don't know them, but they seem exciting. When you throw those 3-4 stocks, $1 billion, $2 billion, in a mix with these big caps, I think it adds a fair amount of diversification. One other quick comment, Kevin. I love his financials exposure.
Yeah.
He has JP Morgan, he has Bank of America, he has Morgan Stanley. This is, again, an area of the market that everybody and their grandmothers hate with all their passion. And when I see someone holding those 3 positions, he has PayPal and MasterCard and Visa and all those guys too. So those are more conventional. Those are like the trades that have been working.
So you're saying that there's every reason to hate the value that the big banks are.
That's right.
With the yield curve just going like that.
That's right. So these 2 things, when I saw that in the portfolio, that this person has so much semiconductor, and hopefully he had the whole thing as we described earlier, and now I'm looking at these big banks and he's holding on to these. This is someone who has a good grasp of fundamentals. He can move beyond the current prevailing patience of the market and look ahead.
Yeah, because I see, so you mentioned some of the small caps like EDIT, BEAT, Funko. Those are small cap recommendations from myself and Brian Boland, who focus on these small growth companies. And so EDIT is the gene editing company, BEAT is heart monitoring, and Funko makes the toys for the Fortnite games and a bunch of other licensed games. So, but myself or Brian Boland don't recommend the big banks, so this person's doing their own homework too in areas to have a balanced portfolio. The other things that stood out to me, besides the chip ownership, which is, has done well, is the software too.
Sure.
I see he's got CRM. I'll call Square the software fintech crossover. And what else did I want to note here? So, and I had to look for other healthcare. So I think we've got 4 healthcare holdings with Sanofi, the big French drug maker. Then Abbott. XBI. This is what we didn't talk about. This is the equal weight biotech ETF. So it's it gives more leverage to the small and mid caps. We were buyers of that right after the Christmas lows, and that's worked fantastic because you're getting that gearing from the small caps. What else did I want to note here? Well, I want to bring up something else interesting, Sheraz. This person who submitted this portfolio also had a question, I think, that everybody who's got a portfolio is thinking
correct.
about. What happens or doesn't happen with the China trade deal? Let's say we get, it never gets resolved, or we get resolution soon. What should investors be thinking about, I guess, is the question.
Yeah, we actually, John Blank and I had that topic for our Agree to Disagree segment too. So my thesis on that, Kevin, is that a fair amount of optimism or the actual agreement is already priced in, and we discussed it over there. John brought up a good point that the key part of the details or the fine print part of the agreement that would matter to the market is what happens to the tariffs that are in place already. Do we get rid of the tariffs along with the agreement, or some remain in place, or all remain in place, and that will determine how the market responds to the agreement.
But overall, it strikes me that it still almost doesn't matter, because the market's not levitating on fumes of possible trade peace, right?
No.
The market, to me, has done a remarkable job at discounting a potential earnings recession. Right?
Yes.
And you look at it, we look at it by the broad market. We look at it in terms of just semiconductors.
Sure.
We've got an earnings trough coming up here.
Yes.
We're not there yet.
Yeah.
Does it happen in Q2? If it does, if Q2 becomes the earnings trough and we have a mild earnings recession, then the market is flying away and looking at new highs because growth is around the corner. So that's kind of the biggest if, I think, for portfolios is if the trough is credibly discounted in Q2, or it's going to get pushed out, and we have more earnings impact that we don't know about.
Absolutely. The negative in real fundamentals in earnings particularly is tied to this trade issue. But it's a bigger comparisons issue to the basic arithmetic of how big and strong 2018 was, and it'll be difficult to move the needle in any situation. But the outlook for 2020, which everybody has their hopes on, and you mentioned the second half in the context of the semis, as we get to the middle of the year, as these management teams start sharing their outlook for that second half, and if they are pushing everything into 2020, then I think confidence about the earnings outlook will be reset, and it will be reset in a negative way.
Oh, okay. All right. Well, that's good to keep in mind, because right now it seems like if you thought it was just this market performance chase pushing the market higher, there's been plenty of chances where we could have pulled back and didn't.
That's right.
And so it seems that confidence is sort of back at an all-time high among investors.
Sure.
So maybe that's the that's the way the weight can shift, so to speak. When confidence is so high, how much higher can you go? But that's what we'll be watching. Be sure to tune in to the segment Agree to Disagree to hear Sheraz and John Blank get into the details of the possible China trade deal. All right, thanks for joining us.
Here now, a few things you can expect to see coming up. Our mobile app includes features just for Zacks Ultimate members. In addition to having access to real-time pricing data from BATS, you can opt in to receive trade alert notifications and service updates for each portfolio you follow. Plus, be sure to check out the new Ultimate 4 and 5 stocks set to double special reports, which were recently posted on the Zacks Ultimate homepage. And remember, the next Zacks Ultimate Strategy session will be posted in early May. So start thinking now of those submissions for the Zacks Mailbag and Portfolio Makeover segments.
All right, my top stock is Cinemark Holdings, ticker CNK. They are a leader in the motion picture industry. They operate 408 theaters and 4,657 screens in 38 states in the U.S., along with 12 other countries, mainly Mexico, South America, and Central America. At the moment, they are a Zacks rank of a number 3, but they have a VGM score of A, and their industry is ranked in the top 30% of Zacks ranked industries. Their one-year projected EPS growth rate is 24.96%, which is 2.5 times that of their industry. Their return on equity is 14.59%, which is nearly 1.5 times their industry. And their PE ratio using F1 is 17.50, which is 11.5% below their industry average. I also like that their price-to-sales ratio is low at 1.45. As statistics show, this gives them a higher probability of going up. Now, I'm expecting a big summer movie season this year with the release of Avengers Endgame, but there are also plenty of other potential blockbusters coming out. And this year's box office receipts are expected to set new records. I also like their chart as I think it forecasts big profit potential. They've traced out a large 4-year-long bullish basing pattern called a symmetrical triangle, and technicians will measure the size of the base, which in this case is $19, and then add that to its breakout point to get the measured move price target. That's because typically the ensuing move after a breakout will be as large as the base that it broke out from. So adding that to the breakout point, which is $44.25, puts the price target at $63.25. And a move to $63.25 from where it is now, which is right around $40, equals a move of more than 58%. That is a sizable move and pretty impressive return.
John Blank, top pick. Now, I want to tell you all that I am the large cap trader editor. What that means is I'm looking at large cap stocks that are unknown but should be known. This is my top pick, Synex, ticker SNX. What does Synex do? It's a company that deals with the business-to-business issues in infotech. It's actually in 30 countries. It bought a big company called Concentrix that's integrating into its business. So you probably don't know Synex because it bought a lot of companies, a roll-up. It's a bigger company than you think about, ticker SNX. So all I want to do today is go through the price and consensus chart for Synex and why I like it. So again, all you're looking at is the annual estimate lines for 15, 16, 17, 18, and 19. Look at how this stock should be trading at, which is $140 a share. I put this one in the 90s. We're trading at 104 today, so you can see that once we get beyond this 104 level, we can stagger our way up to a 30 or 40% gain on this stock. And by the way, that's already happened in early 2018, a year ago. So what you got to like about this stock chart is, along with the estimate revision on an annual basis going in the right direction and showing you that value, you've also got the quarterly earnings reports. And look at how many green arrows there are. You got to go all the way back to 2015 to find a red arrow. That means for years now this stock is outperforming. That tells you this business is outperforming. So the stock sold off because it was a growth stock and a tech stock. Is cheap. It's already priced in 140. You can get back there. The estimates have not gone down. They have gone up because of this merger with Concentrix. This stock, you got a 40% gain here over a year and a half. That is all the news I need to give you. It's SNX, ticker. Go for it.
Well, that's it for this Zacks Ultimate Strategy session. We hope you found it informative. Feedback, always welcome. Don't forget, you can send it to mailbag@zacks.com. And if you have questions about the Zacks Ultimate service, you can contact your account manager at ultimate@zacks.com or by calling 888-775-8348. International callers use 312-265-9309. Until next time, thanks for watching. Thanks also to our production crew. And as always, we look forward to sharing success with you for many years to come.